Hi, good morning, and welcome to the first panel of the conference. I'll briefly introduce myself and then let the other panelists introduce themselves also. I'm Evalinde Eelens. I'm a professional board member. I sit on 4 Dutch pension boards, and I also advise pension funds in the UK on investment governance, fiduciary management, and cybersecurity. So that's in brief. Julia, if I may ask you to introduce yourself as well.
Introduce myself or the family office as well?
Yourself.
Okay, my name is Balandina Jaquier. I'm a Chief Investment Officer of the TARA family office. I'm also involved with a number of other family offices, taking the roles of investment committee member or board member or a family council member.
Thank you. Guido?
Yeah, my name is Guido Boysen. I'm the Chief Investment Officer of Blink, which is a single family office. I've been in impact investing / development finance for over 25 years, starting at FMO, the Dutch Development Bank, and then I led a African fund manager investing in small businesses across Africa and the Middle East.
Thank you. Olaf?
I'm Olaf van der Heuvel. I'm the Chief Investment Officer at Achmea Investment Management. And to be honest, I'm not that experienced in impact investing. So I've been a proper investor, I would say, for a long time now.
No?
Okay. But now, of course, at Achmea, where impact investing is really at the heart of what we're trying to achieve, what we're doing, it's a completely different ballgame. So I'm here to listen, learn, but also probably share some of my insights.
I'm sure plenty of people are willing to advise you during the coffee break.
I saw that by the number of emails I received beforehand. Yeah.
Arjen.
Yeah, my name is Arjen. I'm the Investment Officer of PGGM. PGGM is the pension administrator of a number of pension funds up until including PSW, which is the healthcare sector pension fund.
Thank you. So as we noticed during the introduction earlier today with the cards, there are some differences between family offices and pension funds. So I'm looking to explore that further during the panel. Julia, could you elaborate on TARA's family office's core impact strategy and how you look at the risk-return trade-off of that strategy?
Sure. So TARA family office is a single family office of a Belgian family with roots in real estate, vacation parks. The family has 3 generations. The generation 1, the father is the wealth creator, very actively involved still in the family office. The second generation, 2 daughters. One of them spearheads jointly with the father the family office. And the third generation, there's 6 children in the age of late teens, early 20s. The family office, since several years, spearheaded the transition towards impact investing with the goal of having 100% of their investments focused on impact investing over time. All new investments are impact investments at the moment. We have maybe a bit of a different strategic asset allocation than a pension fund would have, given the roots in active real estate business. The current portfolio of the family, 70% is in real estate and private equity funds, with the remainder in primarily public equity. We are focusing on 4 key areas of impact: holistic health, regenerative agriculture and food, social equity, and climate and biodiversity solutions. And we employ also a few lenses. Those are additional criteria that provides a preference for us to invest. Those are equity and diversity. We prefer diverse teams. We are very keen to support female-led teams and teams led by people of color. We are very keen to support fund managers who employ systemic lens, and we also employ a mental health lens for our investments. We focus on impact investments on the majority of our portfolio, not impact investments, sorry, finance first impact investments, market return seeking impact investments for the majority of our portfolio, but we have a carve out for impact first investments.
Okay, thank you. So Arjen, for you the situation is a bit different because I was looking at all of the people at my table when we held up the cards, and for Julia it was impact first, for you it was finance first. Can you tell us a bit more about PGGM's treaty investment framework and how you balance financial returns, risk, and sustainability.
Yeah, thank you, Evalinde. Yes, so we are a pension fund, basically. So our key fiduciary duty is to make sure that we deliver a healthy pension for our beneficiaries. And for that, you need to deliver financial returns. At the same time, our beneficiaries, the participants of PSCW, the Healthcare Sector Pension Fund, do believe that sustainability is very, very important. So our job, which is a very difficult one, is to try to find the right balance between financial returns on the one hand, within the risk budget that we have, but also focus on sustainability. So that's what we call 3D investing. So for us, in the decision to invest in any company or any real estate or in any infrastructure investment, it's always a question of, okay, what is the risk? Do we understand the risks? What is the financial reward which we get from taking those risks? And where do we stand on sustainability? We also employ what we call a core satellite approach. So the core of the portfolio, which is the biggest chunk of the portfolio in terms of size. Our portfolio is roughly 260 billion. So the core of that needs to deliver that financial return. And at the same time, within that core, we try to find that balance between risk, return, and sustainability. On the other hand, we also have a number of what we call more satellite or impact portfolios, which are much more focused on creating impact. And there we also made a number of decisions together with the pension fund, okay, and which themes do we want to really focus on, and those are, you can probably guess it yourself, which is the healthcare sector in the Netherlands. For PSCW, it's really important that we try to find impact investments that contribute to the problems facing the healthcare sector in the Netherlands. It's the energy transition, which we believe is a very much investable impact theme, and the other one is biodiversity. And we have also specifically allocated AUM to those 3 impact investments.
Okay, thank you. I was wondering, because you didn't mention that, do you still have a home bias where you prefer to invest in Dutch solutions when possible?
Well, in general, I would say no. We are a universal investor and we invest globally. Where we do have a very strict home bias is what we call the healthcare impact mandate, which has a very strong Dutch bias, because obviously we work for the Dutch healthcare sector. So any impact investments that translate literally into positive impact for the Dutch healthcare sector, that's obviously very important to us. But what we also try to do is we invest globally. So when other investment solutions are being found across the globe, what we always try to do is transport those into the Dutch healthcare sector and say, look, this is how they solved this problem in Denmark, or this is how they've solved it in the US. Let's try to work together. So that's something that we do as well.
Okay. Olaf, how do you look at that? Because you also have a lot of pension fund clients and most of the beneficiaries are based in the Netherlands. Do you think you should have a home bias?
Yes and no, of course. That's the easy answer. I think for many of our clients, the participants of pension funds, I think it's very important to have something that they can relate to. So it helps if it's local, that you really can see that change is being made, that we have an impact. And we do see that, and we do think it's important. But of course, we also acknowledge that on the one hand, from a risk perspective, it's good to diversify. You can't be only focused on, say, our direct surrounding. On the other side, I think we really do understand that it's much easier to have a big impact, especially on the social side, in, for instance, emerging markets. So it's a yes and no. It helps to make visible change that people can relate to. It also helps from multiple angles to be a bit more diversified and therefore global.
Okay. Guido, how does that translate to a family office strategy? Do you employ a home bias, and what are the other factors and principles you use to determine your investment strategy?
Yeah, there's certainly a bias, because we have one participant or one LP, which is the family, and
it's so much easier.
It's so easy, but also still so difficult. Yeah, so Blink started in 2019, really with the idea, upon a big liquidity event, the family back to successful businesses. Both were sold, and they wanted to do something with their wealth beyond just putting it in the stock market. So for them, it was really important to move, let's say, impact investing as an approach forward. So for us, that's a key goal. By investing in various impact themes, similar biodiversity, inequality, climate, in different markets. So we are quite active in Africa and Latin America, but we also have exposure in the US and Europe. So we look at different strategies. But yes, for many things, it needs to relate to the family. They need to feel that it's aligned with their values and how they see impact. And maybe I can illustrate this with a small example. The other day, we looked at 2 financial inclusion opportunities in Africa. One is both are credit funds. One supports microfinance organizations with loans, and so the end beneficiary would be mostly women who sell produce on markets. And the other one is a similar credit fund that supports fintechs in Africa that finance productive assets like two-wheelers, motorcycles, where the end beneficiary is usually men who drive around and deliver passengers and packages. And so in terms of risk return, both are equal. The microfinance sort of funds provides 3%. The fintech sort of supports 7%. And let's say they're pretty much the same in terms of risk return, and both are quite low risk because there's lots of catalytic capital, etc. But then you look at the impact profile, women selling produce on the market or men driving around motorcycles. And so then the question becomes, what is more impactful? And of course, one can look at outreach, how many, like a lot of funds will say, we've touched so many people, etc. But I think for us, it's also important, what is the depth of that outreach? In what way does it change the life of that woman or the life of that man who also has a family to support? And I think there it becomes a bit more tricky to evaluate, and it requires more work. And in a way, then bias also plays a part. What sort of impact story, in a way, resonates more with the family. So.
And in the end, which argument outweighed the other?
Exactly. And it's not so straightforward. So these are the dilemmas, I think, when you work really on the ground, that one faces. And one is more market return seeking, the other one is more impact first. We need to be comfortable that even if there is sub-market returns, that impact profile is really strong and intentional and measurable, etc.
That's a great segue into the next question, which is for all 4 of you, but probably different for the pension funds compared to the family offices. Because scientific research shows that if you invest in impact investments, part of the return will be non-financial, because you want to make a non-financial impact as well, an impact on society. Also, concentration risks tend to be higher for impact investments. For the pension funds, Olaf, Arjen, how do you deal with the higher willingness to pay for impact investments, and how much in financial return are you willing to sacrifice to make an impact and still ensure that it's a fitting and appropriate investment for the portfolio?
That's quite a broad question.
Yes, especially with this audience.
So I think we would only consider good investments, but in this case, it of course always starts with what's the impact, what's the theory of change that we have, what do we want to achieve, and what do actually the clients want, of course, that's the first step. And then we build up from there. But I do think, I'm a capitalist. I think it matters. It matters how you measure. I don't believe in soft nurturing or government help. I think we really need to do this from a capitalistic perspective to make it count. And then, of course, given that it's good to have a top-down view on what kind of impact you want to have, what's your theory of change. In the end, there's only so much that's available yet. So I think from a risk management perspective, it's good to consider what type of asset class is there, how do you make sure that you have enough diversification for our clients. I think for family offices, it might be a little different, but that's important. But I also see, and the current environment actually helps quite a lot, that there's a huge opportunity here for technology to step in and actually look at risk management. So we are experimenting with using AI to see what are the trends, what are the risks that we are, and how can we use them in assessing investment cases. So it always starts with impact, but I, as a capitalist, think it's important to make it a real economic effort.
Okay. Right.
There's a lot to unpack in that question. So maybe one is we do a lot of polling in our participants. We do that at least once a year, where we do ask those questions. Do you think sustainability is important? Would you accept a lower pension if the pension would lead to a more sustainable environment? And there is a lot of support actually from our participants that they do believe that sustainability is important. They do believe that they would accept a somewhat, and the key word is somewhat, lower pension to get a very sustainable pension. It's non-specified how much that can be. But it's also quite a large portion. We serve 2.5 million Dutch people, so it's quite an average of the Dutch society. So there's also quite a significant proportion of the participants who really don't want to forgo any pension in exchange for sustainability. So for us, the job is to really find the right balance. Now, as I already mentioned, we employ a kind of a core satellite approach. In the core, which is the vast majority of the portfolio, what we very actively search for is to find the right balance. So we don't accept a lower financial return just for the sake of sustainability. We do believe that there are many, many investments out there where the right balance can be struck. Also in terms of risk management, we would probably not have a very concentrated portfolio. That's just poor risk management. So we would also seek diversification. And within that, I mean, if you look at the entire opportunity set of potential, let's say, let's look at companies for sake of simplicity. The types of companies you can invest in, obviously, there are these companies that are way out there that are extremely sustainable, but they might be a little bit risky or overpriced, that can be, but they could still make some solid investments out there. And there is potentially some companies on the other side of the spectrum that are extremely unsustainable, and you might even want to choose to exclude those companies. But the vast majority of the companies out there is in what we call the middle ground, and we call them improvers. So there are many companies out there that may not yet be very sustainable, but they have very specific and measurable plans in order to improve their business. And we as a pension fund are very willing investors in those businesses if the balance between a credible sustainability plan, a good financial return and risk is met.
I've seen a lot of those polls at the pension funds I work for as well. You never get a clear-cut answer.
You never do, right?
Yeah, you always have to still make a discretionary decision. Julia, you mentioned earlier that currently I think 3 generations are involved in the Tower Family Office. Is it difficult to balance the priorities and preferences of those 3 generations when you look at what the investor preference is for you?
Right. Well, it's definitely a challenge. And I think, whoever knows families knows that there's a lot of family dynamic. People have different views, even within the same generation. Wherever you have, different generations, there are different risk-return preferences, different thematic preferences. So yes, we had to balance it. But I would want to challenge the framing of your question originally.
Go ahead.
Into saying that, and I think, a lot of fund managers present here would probably say, no, we target market returns. I think that impact investment market, and I've been involved in it for over 20 years, I think the biggest change I see from 20 years ago is that the depth of the market is such that you can actually target market returns. Of course, if you go into niche applications, and our family office does go into, regenerative agriculture, into, mental health, there you face concentration risk, maybe, lower returns sometimes. But there are areas where you don't need to sacrifice. I think that is important for us because we, in a way, in our family office, we employ a barbell strategy. We have a significant portion of real estate, sustainable real estate, which provides us with low volatility, stability, and cash flow, and enables us to go for really deeper impact on private equity allocations. Also, within the private equity allocations, we consciously take higher proportion of emerging managers and first-time funds, and that is the second generation push for deeper impact and the first generation grudging acceptance of the higher perceived risk. But we try to balance it by doing deeper due diligence, by really having an alignment on values and, staying closer to them and, in the governance. We also segment our portfolio and our risk and return preferences. As I mentioned earlier, we have a finance first portion and we have, a carve out for impact first. So it enables us to be more realistic into what we target for each of the portions. Because of the family multi-generational focus and really long-term view, we're able to not focus on just short-term performance and short-term IRRs, but really take a long-term value creation view. And in many cases, I think those perceived risks might happen, even with the first-time managers, might happen to be, actually the best investments as well. And the last is probably that we take really holistic view of risk. So for us, risk of, in addition to financial risk of greenwashing, risk of mission drift, and risk of non-delivery of the impact are as important, and we pay attention to that when we evaluate and manage our investments.
Well, first of all, because I did do the research, and I'm sure with selection effect, the managers are available, the opportunities are available to get market return, but I purposely looked at research papers published after 2021, so as recent as possible, but still a large enough scope. And the cut investors are willing to take is still up to 3.7 percentage points compared to non-impact investments, which is good because the willingness to pay is there, but also something we should be aware of, I think, especially, well, all of us talking to our clients or beneficiaries, saying, well, there is potentially a trade-off, and we should be transparent about it.
It is, and I think, with different family offices that I'm involved in, the impact first allocation, we're taking either 0%, just purely return of capital, or half of the market returns. And also even in the finance first allocations, family offices, and I don't know if you would share this agreement, very often we have discussion, what is sustainable return, rate of return, what is non-extractive rate of return that can pass over generation, and we lower our return expectations in order to really make sure that we enable deeper impact even in the market rate type of.
Well, you already asked the question, so.
Yeah. Yeah, and I think there's risk, return, impact, and I guess liquidity maybe is also a factor that plays a part. For us, yes, we have a very long-term view, and some of these innovations, we're very active in venture, for example, and some of these innovations just take very long. And yeah, venture fund, the term of a venture fund nowadays, I think maybe 13, 14 years before the entire portfolio is harvested. So one has to have a very long-term view. I think even sort of climate innovation, let's say climate 1.1 in the US wasn't particularly successful in venture, so there were a lot of problems. But I think now you have funds that are doing really well in climate finance, especially sort of before 20 who didn't overpay. So I think there is strategies, investment strategies that you can back that have an impact and market return, but it might take longer. And yeah, we evaluate each strategy on its own merits. And I very much agree with the idea of being mindful of greenwashing, because we do see that fund managers jump on the bandwagon and sort of put a source of impact over their fund and are not ambitious enough, in our view, in terms of impact intentionality, in terms of really measuring not just outputs, but also outcomes or longer-term impacts. Those things are important to us to really advance the sector.
And for Blink, did you define investment goals with the family?
It's a journey, I would say. So they got into this also as a way of learning, and yeah, we're sort of 6-7 years in, so we are articulating these goals, and yeah, they're first generation, but there is a next generation that indeed have different views. So we're trying to articulate these goals together.
And do you look at both financial and non-financial goals?
Yes.
Or
I very much see it as well as sort of taking a portfolio construction point of view and having similarly like a sleeve for more impact first propositions, although there's very few managers who present themselves as being impact first because they think they won't be able to mobilize money, but the way then we present it to our LP is saying, look, you know, if we get our money back, we should be very happy if this fund achieves those sort of impact goals that it sets out to do.
Yeah, it really depends which group you're targeting, whether you want to approach investment pension funds or family offices.
Correct.
There's, I think, a real opportunity to work together, right, on topics like this, where family office really have this.
How would you see that? Because as we've seen, the ultimate goal can be different. So how would you see a collaboration between those two?
Well, I don't think the ultimate goal is different. I think we all. If
you say impact first for family offices and
but we all want impact,
first?
Right? But of course, for us, there's a different clientele. It's much more spread out. There's multiple opinions, multiple clients. So you need to take that into account. But we do, I think, have the benefit of having large teams. Of course, you know, our head of investment, of impact investing is right here. We have a large team and it's growing and we're investing. We're investing in technology behind it. We're investing in risk management. And I think that all helps and gives new insights. But of course, we lack some of the capital that you have available to go really deep in some areas. And I think together, because I think in climate technology, climate transition, that's fairly easy, well established. Biodiversity also growing and well established, or getting well established. But some other areas, healthy nutrition or equal opportunities, there's still some way to go. And I think pioneers can really build a lot of opportunities there. And family offices have the deep capital that could be used to open up, set standards, and together, I think we can achieve quite a lot.
But would they be willing to do so? Do you see any potential in collaborating with pension funds, Julia?
I think so. I mean, there's a huge, huge opportunity to collaborate, and I think similar to what Guido mentioned about the first time, the impact first carve out for us. We're not necessarily targeting the managers who are targeting below market returns. We're targeting really emerging managers with innovative strategies which have not been yet proven, with the idea to pilot them and scale them through pension funds eventually. The problem is that it takes, we've invested, for example, in a few funds of 25 million, US dollars or euros. So by the time they reach, I don't know, what is the minimum, 250, it's probably not just one fund, one iteration. No, it's not going to be the fund 2, it's going to be fund 3 or 4 or 5. So I think where, if we could, have you step down in the size at least, because the strategies might be, de-risked, but, with collaboration with pension funds, I see a lot is just the minimum size, what is it, 50 million, minimum size, 20%, maximum of the fund, that's where there's a lot of gap. And how we can bridge it? Yeah. I mean, we tend to stay with the funds going further, but by the time the pension funds come into play, it's a long time.
Agreed.
We're getting quicker there.
One thing we haven't touched upon yet, impact is usually linked to conviction. It's quite clear with the family offices, pension funds depend on member questionnaires, but conviction can go hand in hand with reputational risk, especially if you represent one of the largest pension funds in the Netherlands. How do you integrate that into the process?
Yeah, that's a tough one. Obviously, there is on the one hand there's reputational risk, and there is, let's say, political influence, right? So those two are linked to each other. Any large asset owner is always targeted by whatever group, either you're from the capitalist church or from the impact church. They always want you to stand in front of them and use your asset base to basically serve their agenda. So a few years ago, we had Greenpeace in front of our door, banging on our door that we should sell Shell together with ABP. And when we chose not to do it right away, there was this leaky oil pipeline in front of our doorstep. Now it's probably the other way around, right? So if we would make very public that we would sell the entire oil sector, then we would have other folks at our door. What we try to do is to be as apolitical as we possibly can, because we are not there to serve any political agenda. We are there for the beneficiaries of the, in my case, the healthcare sector pension fund. So that's what we do. But on the other hand, those participants do have some investment beliefs, things that they feel are extremely important. And based on those investment beliefs, they do make a number of decisions on where they choose to invest in and where they choose not to invest in. And obviously, those decisions will be criticized by people who have a different opinion, and that's perfectly fine. And I think it's extremely important that as an organization, you're always open to listen to whatever other people with different opinions have to say, because it tends to sharpen up your own opinion, and we might have lost something, right? So we might have missed something. So it's the eagerness and the willingness to learn from other people, and that's also, I totally agree with the previous discussion on we should collaborate more and exchange views and ideas. Is to really to work to that. But at the same time, you can never prevent the fact that once you've made a number of decisions, yeah, some people will say, well, it is not our decision and we want to criticize you on that.
And do you find reputational risk more difficult to manage because it is a two-sided risk, whereas with other risks there's a downside which you want to cover, but the rest is upside? But here, whichever way you choose, someone will be unhappy.
The short answer to your question is yes, because the world has become more polarized. So the world nowadays is less nuanced than it maybe was a few years ago. So also, especially with what's happening currently in the US, certain policy decisions that you might make may have some detrimental effects on how very large countries, where a large portion of our portfolio is invested in the US, might have some consequences. So you have to tread lightly. You don't have to sell off whatever you believe in. I don't think we should do that. But at the same time, it's also being maybe a little bit more careful on what you preach also in broader audiences. Yeah, I do believe it has become more risky than it was a few years ago.
Clearly, the changing societal and political landscape impacts your clients as well, Olaf. How does Achmea approach reputational risk, but also the changing preferences and the more polarized preferences?
Yeah. Well, probably good to understand that. So, Achmea is not a listed company. It's very much driven by a very broad stakeholder model, right? So we want to build a better world for us, for our clients, for everybody involved, and that's in the culture of the company. So this whole political landscape that has been changing, yes, it has been changing. I think it's actually a good thing in a sense, because it's you were talking about impact washing, greenwashing. I think that's all going to get pushed out, which is a positive. But also, it means that our industry has to come of age. It has to mature. So that's why it's important to come up with the right metrics, with the right insights, to make sure that you measure what you do and can be very transparent about that. Have a very good understanding with your clients, understand what they want, make sure that they understand what their participants want. And I think it's all about maturing, coming of age. And I think we are true to our word. We want to do what we want to do, and we are going to stay and continue to do that. So I think it's a very strong point. I think it's a very positive change in that sense. So I'm not negative about it. And if we talk to our clients, we don't see any change. All of our clients still are very focused on making sure they get some impact, have impact investing as part of their portfolio. So we don't see the change with our clients. Some might have some doubts or opinions, but we currently don't see that, and we definitely will not be changing. We do, of course, see some interesting discussions around, for instance, defense spending. How do you deal with that? So there are some interesting new boundaries, and I think your words...
Which could also be political in part.
Exactly. So wise words. Did we overlook something? Did we ignore something? I think there's an open discussion there. But all in all, I think this helps the industry coming of age, which is a good thing.
And Arjen mentioned that PFZW sends out a questionnaire annually. I've never received one, though, and I am a beneficiary.
Well, we send it to about 6,000 participants, so there is a
let's keep her off the list. Her opinions are too strong. And I'm responsible for the ESG policies of most pension funds I sit on the board of. And this year, for the first time, I said, I'm not going to update the policy without sending out a questionnaire, because most funds don't do it annually, but every 3 years or so. And the results were slightly surprising, not as surprising as they could have been. But how do your clients do that? Do they send out questionnaires every year, or do you just listen to the accountability board? How do you make sure that what your clients say they want is what their beneficiaries actually want?
I think that's exactly where the coming of age comes to mind, right? Because I don't know for all the clients if they have a standard frequency or anything like that. I do know that the focus is on getting the right answers, and we all know that. I think if you send out the surveys, what is it, 6% or so of the participants actually respond? So it's very difficult to get the discussion live. So that's exactly one of the areas where we need to get more responsible, become more transparent, invest in technology to make it visible.
Now, we just send out questionnaires and then analyze the answers for you. It's both easier and more challenging because you sit down, so you actually have to have a conversation. And if one person does not agree, you can't just put them down as statistically insignificant and move on. So, Guido, how do you do that if you have conversations with the people of the family office and their preferences are not aligned?
Yeah, a few examples come to mind again, which I like to have examples to make it a bit more concrete. But the other day we looked at a blue ocean fund. You know, blue oceans have an important role to play in climate, and there was one particular company that does monitoring, sort of technology to monitor oceans, and then you quickly get into discussions around dual use, right? And to what extent is this, can we be sure that this is only used for measuring carbon in the sea and not to sort of spy on other countries? So we have a discussion around this. The other example that we recently had is a company we're directly invested in. They do biodigesters, also in the global south. So they basically take cow poo and put it in the installation that creates methane connected to a clean cooking device, which replaces charcoal and has a lot of benefits, climate, but also health-wise, etc. So it's a very great impact case. Now that system is quite expensive for a rural farmer in India or Africa, and the way they reduce the purchase price is by using carbon credit that they sell in the voluntary carbon market, which is then bought by international buyers, including Shell. So we had a discussion within the family to say, look, what do you think of this? Do you like, although there's clear benefits of selling these carbon credits, and in the end it will reduce the purchase price and will benefit people in India and in Africa. But what is your view on sort of getting a company like Shell off the hook by offsetting? Shouldn't they just focus on their core? And so we have these interesting discussions. Then how does the family view the voluntary carbon market, right? And is offsetting something that aligns with their values? So yes, these things are very much discussed. And for us it's important to look at every investment holistically and look at all aspects and not just look at, well, this is great, it benefits farmers, but what else, what other impacts are around this and what sort of dilemmas are there? In the end, we did invest because it's a great company.
And Olaf mentioned coming of age of impact investments in general, yes. And your family office is still relatively young, but do you see them maturing as well in the investment decisions and the processes surrounding investment decisions?
For sure, and I like, it makes me feel younger, I guess. If we're coming of age, it's a bit like a teenager learning, but yes, as we sort of embarked on this journey and we look at individual cases, it will sharpen our investment strategy and sort of I get a better feel for their risk and return and impact and liquidity sort of appetite, what they feel comfortable with. So just like the pension funds, we have a fiduciary duty, and it's important that what we do is in line with their values, their interest. And so, it's not always as clear-cut as these examples illustrate, but as we go through these cases, we learn and we come of age. Yep. I'm not sure when we ever grow up, though.
And Julia?
Well, at Tara Family Office, I think, for us, reputational risk is primarily, related to greenwashing. We don't want to be the dumb money who believes, and I think that is probably the major thing that we look at. We invest primarily through funds, so we look maybe less in the individual deals, but more the fund strategies, and how the fund manager integrates, also, unintended consequences, and, how is ESG managed in addition to, impact thesis. So that's important for us. But I'm involved with several families, and some of them, for example, have very large and very active family businesses, industrial businesses, and the sensitivity there is different. So, for example, I worked with a family that is in alcohol, and there we were saying, okay, what should be the thematic focus, and how can we, in a way, make sure that what family office does on the investments is not perceived in a direct kind of, aggression against the family business. Or, for example, with another family, which was a family office, which is, the family has shipping routes. So oceans was, very important to them. And the idea was to, focus the investment portfolio on oceans. But one family member had a very strong resistance against including of aquaculture, which virtually excluded 90% of all funds out of, so we had to go and broaden the scope to, not just focus on ocean, but ocean being a lens, but just, going further in decarbonization. And so those issues are there, and, defense spending, clean tech starting with defense, we've looked at some situations where, some portfolio companies are, more in AI, which can be used for, energy transition, but can be used for generally, traditional utilities. So how do you measure that? And how do you make sure that, impact is actually happening?
And in a way, I must say, I find it comforting that family offices struggle with translating their investors' preferences into investments as well, and it's not just pension funds.
They do.
As a final question, given all the differing approaches we've listened to, and also sometimes different priorities, could each of you give a valuable lesson or advice to a counterpart? So, which insights from family offices could be beneficial for pension funds, and what can family offices learn from the way pension funds deploy their investment strategies. And since we were with you, Julia, I'm going to stick with you.
Start. Okay, I think what I think the benefits of family offices, and in a way, you know, we're privileged in that sense. I think I call it, you know, value-driven agility. You know, we integrate, you know, values deeply, and it allows us to act fast and act with conviction. And that enables to support some breakthrough innovations, which are, you know, more difficult, maybe for institutional investors. I think, you know, family office really very often focused on building long-term relationships and adding, you know, staying with their, you know, fund managers, particularly emerging managers, you know, and helping them get off the ground, you know, mobilizing further capital. The third one is, you know, anchoring positions. So a number of, you know, family offices I work with, you know, were, you know, seed capital providers, you know, participated, you know, like really, you know, focus on participating in the first close, even take, you know, GP stakes in order to really help build the institutions of this fund manager. So I think that is something that is, you know, unique and possible, but at the same time, I find from pension funds, we family offices sometimes need, you know, to embed, you know, deeper kind of rigor in the institutional processes. You know, one area where I think, you know, we slack sometimes is operational due diligence. You know, and maybe sometimes sticking with the strategy. I think families can be. I mean, on one side, I think it needs to be an evolution, but sometimes, you know, it's more difficult to say, like, look, you know, but we need to stick to
the ability to move quickly has a downside as well.
Yes, and plus, you know, like you have a strategy, but, you know, if the family really, really wants to do something, you know, outside, it's difficult to not do. But I think, you know, that's something that is manageable.
Thank you. Guido.
Yeah, I think it's again a bit related to the coming of age sort of remarks.
That's really sticking with you.
Yeah. Today, So I think I remember reading, this is already probably 10 years ago, a quote by Bono, the lead singer of U2, who sort of dismissed impact investing as good guys doing bad deals, right? And I think now, I think institutional investors can indeed look at family offices because we are good guys also doing good deals. And I think we often indeed have a role at the forefront. I mean, we ourselves are very much trying to build the venture space in emerging markets, and I can see why some emerging markets are a bit too, you know, one step too far. But I think there are emerging markets, India, Brazil, Mexico, where things are happening and where deals are less competitive, where valuations are less high, and where you actually can have really very good opportunities, both from an impact point of view and a financial return point of view. So I think looking at family offices that are supporting these emerging managers that at some stage will reach a level and a size where pension funds can step in, I think I fully echo that.
Okay, thank you. Olaf.
Yeah, I think it's actually been covered for quite a bit. So the early adapter point, I think it's valid. You know, where do we find new markets, new environments? How do we set the standards there? What do we look at? What do we measure? I think family office just are early adapters there. So that is.
So you don't have any lessons learned from a pension fund perspective?
Well, that's the second part. So indeed, that's about, and I think you said it already actually, so it's about the rigor. We're the big machine. So we will bring more money, more capital, but also more standards, more reporting standards. How do we package this? How do we structure this? So I think it's a logical combination of sorts to work together in that sense. So I think there's something for both.
And I think the further away you move geographically, Mexico, the more important ODD becomes as well.
Yeah, that's a good one. Yeah.
So. Final words
in
for you,
the dying
Arjen.
seconds, yeah, sure. So I very much agree with the previous speakers. I think what institutional investors like us bring to the table is a lot of rigor, I'm now eyeballing Pete. I know Pete hates committees, but sometimes committees can also be a hedge against too quick of decision making sometimes, where speed is maybe not your friend. Collaborating, I would say, a lot of pension funds across and all other asset owners around the globe have been collaborating quite effectively, and especially in terms of engagement, for instance, it's extremely effective. The other thing that was mentioned also by the chairman is the importance of data, and making sure that we don't, come up with our own sets of data, their own sets of taxonomy. So really work together in order to make things measurable, because if you make it measurable, it gets managed. And in the end, it's all about real-world impacts with good financial returns. That's what we're all in for. And when we can bring those two worlds together, then I think we can make a real difference.
I think that's a beautiful summary. Real-world impact with good financial returns. Thank you.